Hello, everybody. Welcome. My name is Carmen Federico. We'll be talking with you about some accounting fundamentals. We're going to start out with some introductory accounting terms. You're going to find out accountants have a language all their own. What you might think a word particularly means, accountants have a definition altogether different than what you might think. But we'll find that out more as we go along. But first of all, we're going to start out with a little illustration and focus on some important basic principles of accounting. So I'm going to share my screen with you all. So I'm going to do that right now and call us up this little illustration. You should see a blank Excel spreadsheet in front of you. Okay, so if I were to ask you what a company might own, type that in here. What are some things a company owns? Well, they can certainly own equipment. They can own buildings, right? Spelled correctly. Well, okay. Buildings. They can own, what else? Cash. Inventory. A lot of things a company might own. Okay. Equipment, buildings, cash, inventory. They might own some trucks, right? They might own some, what else? Investments in other companies. A bunch of things they might own. Okay. On the flip side, they own a bunch of things. They also owe. Nice, but business doesn't owe anything. But typically, if they have equipment, they might have an equipment loan. If they have a building, they probably have a mortgage. Right? Then they have their, maybe some employee benefits they might owe. And everyday monthly bills. So every company owns some things and they owe some things. The difference between what they own and what they owe is called the worth. So for fun, if we said this company owns $10 million worth of stuff, right? Equipment, buildings, cash, inventory, trucks, investments, and they owe all this stuff, the loans, the mortgages, benefits, all that good stuff. Let's say it's $6 million. So fun, accounting's fun. We can make some numbers up in this illustration. Can't make numbers up in real life though. You can go to jail for that, but we can make numbers up in this illustration. So anyway, so we have $10 million of what the company owns. They owe $6 million. So their worth is going to be 10 minus 6 or $4 million. Okay. Well, accountants have terms for what a company owns, what they owe, and what they're worth. Accountants call what a company owns assets. Accountants call what a company owes as liabilities or debt, D-E-B-T. And then what a company is worth is called equity. So very important terms. As I said, accountants have languages has a language all their own. So assets, what a company owns, liabilities, what a company owes, and equity is what a company is worth. So if we put an equal sign here and put a plus sign over here in this column, we have what we know as the accounting equation. Assets equals liabilities plus equity. This is the most fundamental and most important thing in accounting. As simple as this looks, it's very simple, right? You have assets equals liabilities plus equity. But this equation must always be balanced. The left side of our equation must always equal the right side of our equation. Always, must always be equal. So we're going to be focusing next on this next illustration I do with you all. We're going to be learning as what accountants do. They analyze business transactions in light of this accounting equation. So we're going to be analyzing a series of transactions next on the next illustration we do together. And when we see how accountants will analyze these business transactions in light of the accounting equation. What accounts are being impacted? Is the account an asset? Is it a liability? Or is it an equity? For instance, if a company buys a piece of equipment, what is it? What's coming into the company? Equipment. And if they bought it on account, on credit, okay, that means that they bought the equipment and they're going to pay for it later. So how does that impact in the accounting equation? Well, the equipment is something the company owns, so that's an asset. And they have a loan, that's something the company owes. It's a liability. So we're going to see, as we analyze business transactions, that whenever we do something on the left side of the equation, we have to do something equally on the right side of the equation to be balanced. Because as you see, $10 million equal to $10 million on the right side, broken up between the $6 million of liability and $4 million of equity. So we're looking at a series of transactions as we go through in our next illustration. So I'm going to stop sharing my screen with you for this, and I'm going to call up another screen with you. Okay, that's good. Okay, so let me find another screen with you as we go through this illustration together. Again, what we're doing, we're analyzing business transactions. That's what accountants do. They analyze business transactions, then they will record them in a journal, post them to a ledger, and we'll be seeing that in our second video. So this video is just going to focus on analyzing business transactions in light of the accounting equation. So let me share with you my screen, and we'll call up a spreadsheet here. Hopefully you all see that. And here it is. It's a series of transactions. It says Jim Fortune started a web service business. Let me make that a little bigger for you all. Jim Fortune started a web service business, Fortune Corp, on August 1st of the current year and completed the following transactions for the month. Okay. And you see a series of transactions. August 1st, he started his business, and all the way through August 30th. Okay. So what we're going to do is we're going to look at the series of transactions here. We're going to see how they are impacted on the accounting equation. And let me share this more of the screen. I'm going to scroll over to the right. And you see this little worksheet I put together here. You have the accounting equation. You have the assets in the green and liabilities and equity accounts in the blue highlighted region of the spreadsheet. Okay. So, and you see that so under the asset section, we've got cash, accounts receivable, supplies, a computer system. These are all things the company owns. What are receivables? Those are invoices the company sends out for work that they do, and that's money due them. That's an account receivable. As I mentioned, accountants have language all their own. Okay. On the liability side, you see accounts payable. So accounts receivable, money that's coming in someday. Accounts payable is money going out someday. Okay, so receivable coming in, payable going out. All right, and you see loan payable. We'll talk about unearned revenue in a bit. And then you have all these under the equity umbrella, stockholders equity, because we're dealing with corporations. We're talking about corporations as opposed to sole proprietors or partnerships. Okay. So we have under the stockholders equity umbrella, we've got some accounts. We have the capital account, the common stock, and we have all our retained earnings accounts that impact retained earnings. So these two, capital and retained earnings, are the major sections under the stockholders equity section of a company. Okay. Under the capital, again, you have all your common stock or preferred stock. If there's another, we'll talk more about stocks in another video later on. Okay. And then we have retained earnings. We've got revenue, all your expenses. What the company's in business to do? They're in business to generate profit. And revenue minus expenses will show how much net income that the company has. We'll talk more about that in a bit. Okay, so let's go back over to the series of transactions and let's look at the first one. On August 1st, Jim opened up a business bank account with a deposit of $50,000 in exchange for issued common stock. So we go over here. So first of all, we ask yourself, as you analyze the transaction, What's coming into the company? Well, you open up a business bank account and put $50,000 into the company. In exchange, you get some common stock. So he's the major stockholder. He's the only stockholder so far of the corporation. He's starting it up. Okay. So what's coming in? Cash. Cash is coming in, right? You put $50,000 in the business bank account. So if we look over here at the accounting equation, okay, we've got cash over here as an asset, and cash is increasing. So we're going to put it over here as a plus, $50,000. So what we know about the equation, the accounting equation, what we do on the left side of the equation, we have to do something similarly on the right side of the equation. So what did Jim invest? What did he do? He invested $50,000 of his own money into the corporation, and he gets some common stock. So we look over here, we see common stock is under the stockholders' equity umbrella, $50,000. So we have increase on the left side of the equation under the asset side, and we have an increase on the right side of the equation in the common stock section. Okay, so there's our first transaction. Again, we're analyzing business transactions. We're not doing any formal accounting yet, other than looking at a business transaction and see how it affects this all important accounting equation: assets equals liabilities plus stockholders' equity. So we scroll back over here to the left, we see the next, on August 2nd, what happened? Jim borrowed $25,000 from the bank. Okay, so he's borrowing money. And I'm going to stop here for a second and tell you, analyzing business transaction is the most difficult thing in accounting. It's the most difficult thing. If you can get the analyzing business transactions down, then everything else should be much smoother for you. Okay, so analyzing is where it's all at, where it begins, where your understanding of accounting. So the next, on August 2nd, what happened? He borrowed $25,000 from the bank. When you borrow money, what happens? You're getting money from the bank. So money is coming into the corporation, and at the same time, with borrow money from the bank, we owe the bank, right? So we have something that we own, $25,000 now. We own that. But at the same time, we owe $25,000 to the bank. So let's come back over here to this accounting equation. And we see cash coming in. So we're going to put $25,000 here as cash coming in. So now we have $75,000 of cash. We had 50 from an initial investment, and Jim just borrowed 25,000 more. So now we have $75,000 of cash. So $25,000 of cash on the left side. So we have to do something on the right side of the equation. What are we going to do? We have to put the 25,000 as we owe somebody something. And we took out a loan. So $25,000 loan. So we have the increase on the left side, assets going up, increase on the right side, liabilities going up. So if we add them up, total, now we have $25,000 in liabilities, and we still have $50,000 in common stock. So if we look at our accounting equation, we have $75,000 on the left. These are just balances here, right? $75,000 on the left, and we have $75,000 on the right, and we're in balance. Beautiful thing. It's a beautiful thing when you're balanced. Okay, so let's go over to the next transaction, August 3rd. What happened? We purchased a computer system for $10,000. Purchased a computer system for $10,000. So what's happening here? We bought something. The corporation bought something. What do they buy? A computer system. What type of account is computer system? We only have three choices. It's either an asset, a liability, or an equity account. Well, a computer system's an asset, something the company owns. And how do they pay for it? For $10,000. It's cash. Okay, they didn't say they bought it on an account. If it says on account, that means they use their credit card, or they get invoiced for it. So let's go over here to the equation, and we see we have an asset called computer system that's increasing by $10,000. But how do we pay for it? Do we borrow money, or do we pay cash for it? We paid cash, so cash is going down. Now you notice on this side of the equation, we have one asset increasing, one asset decreasing. We have one asset coming in, one asset going out for the same amount. So there's no impact on the other side of the equation. because all contained here on the left side of our equation. One asset increasing, one asset decreasing. Now we add up the totals. We have $65,000 of cash, $10,000 computer system. We still owe $25,000, and we still have $50,000 of common stock. So far, so good, right? Counting's fun. All right, so let's go over to August 4th. August 4th, we completed a web service job for a cash customer for $5,000. So we completed a web service job. Well, what's this guy in business to do? He started a web service business. That's what he's in business to do. He's creating revenue. He's generating revenue. That's a good thing. Businesses need revenue. If they don't have revenue, they're not going to be in business much longer. Okay. So Jim completed a web service job for a cash customer for $5,000. I love those cash customers. Okay. So let's go over here to the equation and see what we're going to do with this $5,000. First of all, you get $5,000. When he received $5,000, what is that? It's cash, right? Cash coming in. So we know cash coming in, $5,000, right? So our left side of the equation just increased by 5,000. So we need something here on the right side of our equation. What are we going to put it in? Well, he's in business to generate revenue. That's what he's in business to do. That's what he did. He completed a job, what he's in business to do, and he get paid for it. It's a beautiful thing. All on the same, at the same time, we're going to record the revenue of 5,000. And we're going to reflect that on this accounting equation, right? So we have cash increasing by 5,000, and we have revenue increasing by 5,000. Okay, increase on the left, increase on the right. So let's total up. Now we have $70,000 of cash. He still has $10,000 of computer system. He still owes $25,000. He still has $50,000 in common stock, and now he has $5,000 in revenue. If we add it up, we get $80,000 of assets, right, on the left side of our equation, and we have $80,000 of liabilities plus equity on the right side of the equation. Beautiful thing. We're balanced. Okay, so let's keep going. Let's look at the next one. On August 7th, we purchased $3,000 of supplies on account to be used next month. So we bought some. We bought some supplies. We're going to put them in our storeroom, and we're going to use them next month. So we're not using them up right away. We're going to use them next month. So what are those supplies? What are they? Are they an asset? Are they a liability? Or are they an equity account? What are they? Well, if we bought them and haven't used them yet, then they're an asset. They're sitting in our warehouse or storehouse, whatever you want to call it, and they'll be used next month. So they're an asset. And how do we pay for them? It says we purchased them on account. Okay, on account means we're going to pay for them later. So let's go back over to our spreadsheet over here, and we see that we have an account called supplies. Okay, each one of these are called accounts. These are all accounts. Each account, picture an account in the accounting system is someplace where you record transactions. Okay, so supplies, $3,000. They're increasing. The assets are increasing by 3,000. How do we pay for them? Do we pay for cash, or we're going to pay later? We bought them on account. So we have an account here called accounts payable for all those invoices we'll have to pay eventually. So accounts payable. Okay, it's just a regular payable for being in business, as opposed to a loan that you get from a bank. And we'll talk about unearned revenue in a bit. But anyway, so we have increases on our left, increases on our right. It's a beautiful thing. So we add them up, $70,000 of cash. Now we have supplies of 3,000, computer system of 10. We owe 3,000 for payables, 25,000 on a loan, $50,000 we have as common stock, and we generate $5,000 of revenue. So again, if we add up our totals, we have 83,000 on the left, and we have 83,000 on the right. We're in balance. As we go to August 10th, let's look at the next transaction. August 10th, we paid $400 for supplies purchased and used this week. So we bought some supplies. We paid. What does that word paid mean? The word paid means cash is leaving the building. It's flying out the door. Cash flies out the door. The only thing that flies out of the door of a business faster than cash our employees at 4:59 on a Friday. Anyway, so cash is flying out the door, $400 for supplies purchased and used this week. So we're not putting them as like we did on August 7th, we put them into our storeroom to be used later. We're using these $400 right away, using them this week. So we go over here to this spreadsheet. We know that cash is going down by $4,000. So we show that as a reduction in cash. We paid. Again, the word paid means cash is going out. Okay. And then what else do we have? So we have the left side of our equation going down by 400. We need something on the right side going down by 400. Well, we have something called supplies expense. And that is going to reduce our equity by $400. Expenses reduce equity. It's not that we have negative expenses. The reason we put a negative sign in front of this is not that we have negative expenses. It's that expenses in this analysis are showing as a reduction in equity. That's what expenses do. They reduce equity. Revenues increase equity. Expenses decrease equity. Okay? Revenues and expenses are always at war with each other. Revenues minus expenses, they net against each other, get your net income. Hopefully businesses have more revenues than they have expenses, so they make money. If their expenses exceed their revenues, then they lose money. Okay, so anyway, it's in as a negative. It's nice to have negative expenses in the business. I would love to have a business with negative expenses, but that's not why it has a negative sign in front of it. It's because expenses reduce equity. Okay, so if we do the totals here, we have cash of $69,600. $3,000 in supplies, $10,000 for computer system. We still owe $3,000, $25,000 at the bank. We owe $50,000 of common stock. We have $5,000 in revenue and $400 of expense. Again, the left side of the equation equals the right side of the equation. Okay, let's keep going. August 12th, making good progress here. August 12th, we received $6,000 in advance from a customer for a job to be performed in October. So here we are in August. And one of our customers paid us up front in advance. Those are the best kind of customers, those who pay you in advance. Doesn't get much better than that. Okay. So received $6,000 as opposed to paid. So paid means cash going out. Received $6,000 means cash is coming in. So we have over here on the cash coming inside, we're going to go back over here to our spreadsheet. Cash coming in, $6,000. Okay. However, we did not perform the service yet. So we can't record the revenue because you recognize revenue when it's earned. We haven't earned anything yet. All we did was get the money in advance. We have an obligation now to perform our service, but we haven't done anything yet. So we haven't earned anything. So we can't record the revenue because we haven't earned it yet. Instead, we have something called unearned revenue. Here's where unearned revenue comes into play. This is a liability because we get the money up front, but we haven't performed the service yet. We have an obligation now to perform this service for the customer. Okay, so we have a liability. So we have assets increasing by $6,000, and we have liabilities increasing by $6,000. We owe this obligation to fulfill this service. Okay. So again, it's going to be done in sometime in October. Well, and then we'll see how unearned revenue is taken care of when we actually perform the services in a later video. Okay, so let's total it up. So now we have totals. We have $75,600 cash, $3,000 still of supplies, $10,000 computer system. We still owe $3,000, $25,000. Now we owe $6,000 unearned revenue. That obligation, and then we don't owe the money. We owe the service to perform of $6,000 worth of service. Got $550,000 of common stock, $5,000 of service revenue, and $400 of expenses. Okay, we're cooking. Okay, let me just lock these, freeze these frames here as we scroll up. Okay, look at August 15th. Okay, let's go here to August 15th. Oops, I can't do that. I can't freeze that because I gotta get over here. Let's go over here. We unfreeze for a second. Sorry about that. Let's go back over here. August 15th. Okay, August 15th, what happened? We paid office salaries, $4,500. What does the word paid mean? It means cash flying out the door. And office salaries, what's the cost of doing business? We have to pay our people who we've hired. And it's going to be salaries expense. Expenses are just a cost of doing business. Okay, so let's go over here and record this. Reflect this in our accounting equation. So cash leaving the building. So we show that as $4,500 of cash going out. Okay, and we have something here called salaries expense. Okay, $4,500. It reduces equity. Why? Because expenses always reduce equity. Revenue increase equity, expenses decrease equity. And we have, again, what we have on the left side equation, we must do something similarly on the right side of our equation. Okay, so if our left side goes down by 4,500, our right side has to go down by 4,500. Okay. Again, expenses decrease equity. So our new balances are going to be 71,1, 3,000 supplies, 10,000 computer system, still 3,000 for payables, 25,000 for the loan, still have 6,000 unearned, $50,000 of common stock, 5,000 service revenue. We have $4,500 of salaries expense and $400 of supplies expense. If we add up our left side, we have 84,100. We add up the right side, we have 84,100. Looking good so far. Accounting is fun, isn't it? Well, I think it is. So let's keep going. Let's go over here. We've got August 17th. We billed a client $8,000 for a web service job completed today. Okay. So again, what's going on here? We billed a client $8,000. What does that mean? We sent them a bill for $8,000. They're going to pay us later. So we have to figure out what account that is. Okay. For a web job service job that we completed today. So we earned something. We earned $8,000 for this web service job, but we didn't get the cash yet. All we got was a promise to pay in the future after we send the invoice out to the customer. So we'll go back over here. Let's look at it. We have what to choose from. We have something here called accounts receivable. When we send out invoices to a customer, we're going to receive that money at a later date. That's called an accounts receivable, right? That's an account, a customer on account. They're going to pay us later. Okay. So we know our assets are increasing by 8,000. Accounts receivable are assets. Okay. So on the right side of our equation, we have service revenue. We just completed a job. We have service revenue. That's what we're in business to do, right? To our web service. That's what Jim is in business to do. So if we total up have our totals again, our balances, add them across. That's all we're doing. Just adding them down. Excuse me, not across, down. Now we have $13,000 of revenue. $500 of salaries expense and $400 of supplies expense. Everything's balanced so far. So far, so good. We still have a handful of just over about half a dozen entries left to do. We'll be done with this illustration. So let's go over to the next one. August 20th, we paid the rent, $2,500 on the business van for the month. Okay, so it's rent. Okay, you might make an argument, well, it could be vehicle expense, but usually companies like to keep rent expense separate from their vehicle expense. They like to keep track of what their rent expense are. They can probably rent, they can rent equipment, they can rent vans, they can rent buildings. There's a lot of things they can rent. So we paid, what does the word paid mean? Cash, leaving a building, and rent. Rent is a cost of doing business. It's an expense, but $2,500 of rent expense for the month. So let's go over here to this table. And we've got cash going down by $2,500. And at the same time, we have an account here called rent expense, $2,500. Again, some might say, well, why don't we put in vehicle expense? You could, but we'll throw it in rent expense, okay? Because it's rent. Okay, it is what it is. It's rent. Okay. So then what do we have? We've got cash of $68,600 now. We have $8,000 in receivables, $3,000 in supplies, $10,000 computer equipment. We still owe 3,000 in payables, 25,000 in loan. We still have $6,000 of unearned revenue, $50,000 of common stock, $13,000 of revenue, $4,500 of salary expense, $2,500 of rent expense, and $400 of supplies expense. Again, the left side of our equation equals 89.6. The right side of our equation equals 89.6. We're getting in. We're almost there. Half a handful of entries left. We'll be done with this. So let's keep going. August 22nd, we paid the balance due on the supplies purchased on the 7th. Remember, we bought $3,000 of supplies on August 7th. Now we're going to pay for them. Okay, we're going to pay for them on August 22nd. Paid means, again, cash leaving the building, and we're paying a balance that was due that we purchased on the 7th. So we go back over here to our spreadsheet. Okay, we've got the cash account is going down by how much? $3,000 that we paid. Okay, and we have an accounts payable going down by $3,000. We no longer owe that money. We've just paid it off. Again, assets going down by $3,000, liabilities going down by $3,000. Again, whatever you do on one side of the equation, you have to do the same on the other side of the equation. So now we total up, we have 600 in cash, $8,000 in receivables, $3,000 in supplies, $10,000 for the computer system. Now we owe zero. It's a beautiful thing. We don't owe anything for accounts payable. We still owe $25,000 at the bank. We still have $6,000 of unearned revenue, $50,000 in common stock, $13,000 in service revenue, $4,500 salaries expense, $2,500 rent expense, and $400 supplies expense. Okay. Now look at August 24th. August 24th, we paid $800 for an advertising promotion. So again, the word paid means cash going out the door. And what is advertising? It's a cost of doing business. So it's an expense, right? So we have over here, let's go back to our table. We've got cash going down by 800. And we have to find an account called advertising expense, which we have right here, $800 of advertising expense. Okay. So now we total everything up. We've got cash of 64.8, 8,000 of receivables, 3,000 of supplies, 10,000 computer equipment. We owe zero for accounts payable. We still owe 25,000 for loan payable, $6,000 unearned. We have 50,000 common stock, 13 in service revenue. I'm just going to total these up. And then now we have $800 of advertising expense. Okay, so almost done. We're getting there. We have a few more entries to go. August 28th. August 28th, we paid $150 for gasoline for the van. Okay, so $150 of gasoline for the van. Again, the word paid, must be getting used to that by now, means cash going out the door. So we're going to put that right there. $180 cash going out the door. What is happening? $150 is what? Gasoline is a cost of doing business to drive the van. So we have something here called vehicle expense. We'll put that in the vehicle expense column as a negative 180 because vehicle expenses reduce equity. So now we add everything across. Let's go backwards this way. Keep it easy. Whoops. Type would be dangerous. And all I'm doing is putting totals down. That's all I'm doing, adding up. Okay, so we have here, you can use Excel to add for you. Okay. All righty, so we're getting there. We get, let's see if our equation equals. So on the left side of the equation, we've got 85,620. On the right side of the equation, oh, we got something here going on, 85,620. What do we do? What happened here? Vehicle expense. Oh, it's 150, not 180. Hello, just found an error. Beautiful. Okay, there we go. All right, we're good. We're good now. The vehicle expense is 150. I don't know where I got 180 from. So I get from bouncing back and forth from screen to side here. Okay, 150. Okay, August 29th, we collected $3,500 on the amount billed on August 17th. Remember, we billed our client $8,000 on August 17th. Now they're paying us $3,500 of that. That's a beautiful thing when they pay us, right? So we're gonna go over here and find our asset called cash. Cash is coming in by $3,500. So put $3,500 increase to cash. And what's being paid off? The customer is paying off their accounts receivable balance. So we're going to show that decreasing by $3,500. So we have one asset increasing cash and one asset decreasing accounts receivable. No impact on the other side of the equation because the net effect on this side of the equation is zero. $3,500 increase, $3,500 decrease, zero. Okay. So that's an innie and an outie. Okay. One's coming in, one's going out. Okay. So let's add them up. Total cash now. We've got 68,150. Now we have only $4,500 of receivables, 3,000 of supplies, 10,000 for our computer. We owe nothing in accounts payable. We still owe 25,000 for the loan. We still have $6,000 of unearned revenue, 50,000 in common stock, 13 in revenue, $4,500 of salaries expense, $2,500 of rent expense, 400 of supplies expense, 800 of advertising expense, and 150 of vehicle expense. Okay, we're almost done. Okay, and let's go over here to the last entry on the 30th. We paid the telephone expense of $250. So the telephone expense for the month is $250. Again, paid means cash going out. So we paid the telephone expense of $250. So we know cash is going out by $250. Okay, let's go over here. Lock these titles now. We just lock them because we don't have to go bounce back over there. We lock them right here. So cash going down by $250 for the expense, the telephone expense, and telephone expense. So we have, again, a decrease on the left side, a decrease on the right side. So let's add this up. So our ending cash balance for the month is going to be $67,900, $4,500 for receivables, $3,000 for supplies, $10,000 for the computer system, nothing for accounts payable, $25,000 for loan payable, $6,000 for unearned revenue, $50,000 of common stock, 13 of service revenue, $4,500 of salaries, rent 2,500, supplies expense 400, telephone expense 250, advertising expense 800, and vehicle expense 150. So our total assets, if we hover over these four totals, we get $85,400. We can either type that in or we can just add them all up in this cell here. 85,400. Total liabilities and stockholders' equity are 85,400. But again, we can just put a formula here to add up everything in these cells. We get 85,400. Okay, and that's beautiful. The left side of the equation equals the right side of our equation, and that's how you analyze business transactions. Okay, you analyze them by looking at how they impact the accounting equation. You have three choices. You have the transaction is either going to impact an asset account, a liability account, or an equity account. Okay, And once you figure out what the accounts are that are impacted, then you have to figure out, are they increasing or decreasing? Okay. Paid means cash going out. Received means cash coming in. So I hope this helps you understand some introductory concepts of accounting, analyzing business transactions and how they impact the accounting equation. I'll stop sharing my screen with you all, and stay tuned for our next video on the accounting process. We're going to add a little more to this business accounting equation. So that's it for now. I'm signing off. Accounting is fun. I'll see you next time.